Hello and welcome to this first lecture on key accounting terms and concepts in this course, Finance and Accounting Fundamentals. So in this section, we will take you through some key accounting terms and concepts that we have covered the overview in detail, and specifically we will cover three aspects of that: assets, liabilities and equity. So specifically, as we said, we will talk about in assets, current assets and non-current assets. Liabilities, we'll talk about current liabilities and non-current liabilities. And stock, equity, we'll talk about common stock and retained earnings, right? So let's take a look at each of these as we go forward. So what are current assets? In which we include cash, accounts receivable and inventory. So current assets are assets that are expected to be converted into cash or used within a year or within a normal operating cycle of a business. And they're essential for maintaining the liquidity of the company, cash flow. And there are what are the key types of current assets? The first one is the cash. Cash includes currency, coins, funds available in checking savings account, or it is not all, it is the most liquid asset, meaning it can be easily used to settle liabilities, making it suitable for purchases and investing in opportunities. So first element is cash. Second is accounts receivable. Now accounts receivables represent the amount owed to the company by the customers. So the money due to come from customers. Those customers who have purchased goods and services on credit, and these are usually expected to be collected within a short period, typically 30 to 60 days. And accounts receivables is crucial as it indicates expected cash flow and reflects the company's ability to manage its credit policy. So that is the second element. The third element is inventory, which includes raw materials, work in progress, finished goods that are ready for sale. uh, Inventory is considered as current asset because it is expected to be sold or used within a company's operating cycle, a year typically. Proper management of inventory is vital to ensure that company has enough stock to meet customer demand without holding excessive amounts that could lead to wastages and obsolescence. Now, these current assets are vital for daily operation of the business, and they provide the necessary liquidity to cover short-term obligations and support ongoing business activities. So, what are non-current assets? Non-current assets are long-term investment or assets that the company expects to hold and use for more than 1 year. They're essential for operation and long-term growth of the business. Now, there are two main categories of the non-current assets. The first is property, plant and equipment, PP&E. And these include tangible assets like land, buildings, machinery, vehicles, and furnitures. These are physical assets used in the production process or in administrative purposes. They are not intended for resale in the normal course of business but are expected to provide economic benefit to the company over many years, more than 1 year. PP&E is usually subject to depreciation except for land, which is typically doesn't depreciate. It actually appreciates. Then there are intangible assets. Now, intangible assets are those non-physical assets that provide value to the company. And examples of these are like patents, trademarks, copyrights, goodwills, and brand recognition. Unlike tangible assets, intangible assets do not have a physical presence, but they can significantly contribute the company's competitive advantage and profitability. Intangible assets are usually amortized over their useful life, except for certain cases like goodwill, which is tested for impairment annually. Impairment means what are the deductions that you should make them annually. Now, these non-current assets play a crucial role in companies' ability to generate revenue over a long term and often require significant capital investment. Proper management accounting of these assets are vital to reflect the company's financial health accurately. Then let's talk about current liabilities. What are current liabilities? Now, current liabilities are obligations that the company expects to settle within 1 year or within its operating cycle, which is longer, whichever is longer. Now, sometimes it could be more than a year. These liabilities are typically settled using current assets such as cash or inventory. And what are the key elements of this current liability? There is accounts payable. These represent amounts a company owes to its supplier for goods and services received but not yet paid. Now, this liability arises from purchasing inventory, raw materials, or services on credit. It's a short-term obligation that is typically settled within few months. Efficient management of account payables is crucial for maintaining good supplier relationship and managing cash flow effectively. The second element is a short-term debt that refers to loans and financial obligations that are due within 1 year, and this includes line of credit, short-term bank loans, commercial papers, and current portion of long-term debt that must be paid within that year. Companies use short-term debt to finance working capital needs to cover temporary cash flow shortfalls. It is important for companies to manage this short-term debt carefully to ensure that they can meet these obligations when they come due without straining the liquidity. So, what are non-current liabilities? So, they are the obligation that company is not expected settle within 1 year in its operating cycle. They will go over that, and these are typically more than 1 year and represent long-term financial commitments. Now, what are the key things in this? There is long-term debt that refers to loans and financial obligations that are due more than 1 year from the date of the balance sheet. And this includes the bonds, mortgages, and other forms of debt financing that a company has undertaken to fund its operation, expansion, or capital projects. Companies often use long-term debt to finance large investments such as acquiring property, plant, and equipment. And the repayment of debt is spread over several years, and which helps manage cash flow but also requires careful long-term financial planning. Then there are deferred tax liabilities, which arise when there's a difference between the accounting income and the taxable income that is expected to reverse in the future. For an example, if a company uses different depreciation method for tax reporting and financial reporting, it may end up paying lower taxes in the short term, but will have to pay higher taxes in the future when the difference is reversed. This results in deferred tax liability, which represents the future tax payment obligations that the company will have to settle when the timing difference is realized. So those are the non-current liabilities. Let us now look at what is common stock. Common stock represents ownership in the corporation and constitutes a claim on the portion of company's assets and earning. And what are the elements of this? The first part element of this is what is called ownership and voting rights. So when you purchase common stock, you become a part owner of the company. Common stockholders typically have a right to vote on important corporate matters such as election of the board of directors and other significant corporate policies. Each share of common stock usually grants one vote, although some companies may issue differential class of common stock with varying voting rights. The second thing is the common stockholders may receive dividend, which are payments made by the company out of its profit. However, the dividends on common stock are not guaranteed and typically decided by the company board of directors. If the company performs well and generates profit, common shareholders will receive dividends as a reward in contrast to if the company chooses to reinvestment profit or it incurs losses. The dividends may not be paid. The third aspect is the capital gains. Common stockholders can potentially benefit from capital gains, which incur if stock's market price increases above the purchase price, and if the shareholders sell their shares at a higher price than they paid, they realize a capital gain. However, stock prices may also decrease, leading to potential losses. The fourth aspect is the residual claim. In the event of company's liquidation, common stockholders may have a residual claim on the company's assets, right? And this means that they're entitled to receive whatever assets remain after all the debt obligations and preferred stockholders have been paid. However, such common stockholders are last in line in the event of liquidation. They may receive little or nothing if the company's assets are insufficient to cover its liabilities. The last aspect is volatility risk of the common stock. Common stock is generally more volatile and carries more risk compared to other forms of investments, such as bonds or preferred stock. The value of common stock can fluctuate widely based on the variety of factors, include companies' performance, industry trends, and broader economic conditions. Lastly, let's look at what are retained earnings. Now, retained earnings refer to the portion of company's net income that is kept and retained by the company rather than being distributed to the shareholders as dividend. The earnings are accumulated over time and can be used for a variety of purposes such as reinvestment in the business, paying off debts, or funding future projects. Now, how the retained earnings work? So, retained, as you see in the example given here, retained earnings are calculated by taking the beginning retained earning balance, adding the net income or subtracting the net losses for the period, and then subtracting any dividends paid to the shareholders. So, retained earnings equal to beginning cash retained earnings plus net income or loss minus dividend paid. And second thing we can talk about in retained earnings is the balance sheet. The retained earnings appear in the balance sheet under the equity section. They represent the company's cumulative profit that have not been distributed to shareholders. And the purpose of this is to retain fund earnings for fund expansion, research and development, capital expenditures, and other business need. It also serves as a buffer to cover future losses. So what is next? So having looked at assets, liabilities and equity, we will look at two important aspects in the next lecture of revenue recognition and expense recognition. So thank you so much for watching this first lecture on key accounting terms and concepts. I hope you're continuing to learn new things, continuing to enjoy, and I do look forward to see you again in the next lecture. Please feel free to message me if you have any questions and do download the PDF file to take a look at anything that you need to.